Is it good news or bad news for our property markets? If you've been following the news lately, you may have noticed there seem to be a lot of mixed messages about the state of our property markets. So in this week's Property Insider Chat, Dr. Andrew Wilson and I unpack the latest statistics and economic data to give you a good indication of what's likely to be ahead for our housing markets. If you want to keep up to date with property, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. If you've been following the news lately, you may have noticed there seems to be a lot of mixed signals about the state of our property markets. While some commentators are warning of a looming property market crash due to rising interest rates, the statistics that came out at the beginning of the month from all the major research houses, including Dr. Andrew Wilson's My Housing Market, suggest that our property markets are looking for a floor. Now, of course, that's not unusual. During booms, everyone's positive, and during the slump phase of the property cycle, all the media messages are negative. But as we move to the next phase of the property cycle, it's normal to get mixed messages from the media. Some commentators are ahead of the pack, while others are still looking through the rear vision mirror at out-of-date data. In my mind, Australia's leading housing economist is Dr. Andrew Wilson, Chief Economist of My Housing Market, who brings years of perspective to his commentary, and that's why I enjoy these weekly chats with him. So let's get on with today's chat, where we discuss the rental markets around Australia, some of the latest economic figures that came out this week, including housing.
Yeah, good day, Michael, and very interesting introduction there. And I think, it is interesting also that we're continuing to see that sort of negative mindset in regard to the prospects for the housing market. It's as though the measures that came out for February, which across the board were certainly positive or more positive than January, it's as though it's some shock, that, it's just a one-off event that we've seen, well, in Sydney anyway, that house prices have commenced to rise again. And yet the trends have been clear for the best part of 6 months, Michael, that the rate of decline of house prices that have come through this correction period has clearly eased. We've seen not just an all-of-a-sudden blip over February, we've seen this as part of an ongoing trend over the past 6 months. So it's as though that data has been ignored and that the headline of prices falling is all that's being absorbed, not the trend, and certainly not the historical perspective here. And here we are, that, shock, horror, it can only be a one-off, and it must mean that we will resume a downward movement in house prices and a crash in house prices, according to these commentators that appear to be ignoring the reality and not really doing their homework. And I mean, how hard is this homework, Michael? It's pretty self-evident, and we've been saying that the trends were improving now for months on end, and here we are again. So I guess the future will tell us whether we will see a consolidation of the improvement we've seen over the last 6 months and that other capital city markets will bottom out. But at the end of the day, it's clearly been a process rather than a one-off. But you can't beat a cheap headline. It's called clickbait.
Well, you've also got to look at multiple factors, and there are the auction clearance rates, and
Yes.
there's a days on market and vendor
Yes.
discounting. We'll get to that in a moment, Andrew. But what everyone does seem to be agreeing with is that the rental crisis is getting worse.
Yes, unfortunately, Michael, we've had a predictably tough month for tenants, another tough month for tenants over February. January typically is a month where we don't see a lot of property movements going on. In other words, people shifting into their next home because of the holiday distraction period. But we have seen February, as usual, pick up again. And even that January month showed some lower vacancy rates and higher rents in Melbourne and Sydney. And that's continued over February. In fact, we've got some quite remarkable results in that Sydney and Melbourne rental market, particularly for units. But nonetheless, we've seen, again, an upward movement in rents generally for houses over February. Melbourne house rents up 3% and now over $500 a week. And the annual figures, of course, are sobering for house rents. Brisbane up 24.4% over the year. And no surprise there, given we know there's been that tremendous surge in migration out of the southern states through the COVID period. And that, of course, has put a lot of upward pressure on house rents in Brisbane. Vacancy rates were lower in Melbourne and Brisbane for houses over February, Michael, and generally flat for the others. But the really sobering data came for units. We saw very strong increases in unit rentals over February. Sydney up 3.5%, Melbourne up 6.6%, and Brisbane up 4.5% for unit rentals over the month. This is quite extraordinary. And no surprise, we've seen vacancy rates just falling through the floor in all capital cities, with the exception of that very small market, unit market in Hobart. We have vacancy rates now in Melbourne of just 1% for units, and that's significantly lower than the 5 or 6% vacancy rates we had around about a year ago, Michael. And no surprise that Melbourne and Sydney unit rents, let's be clear, these are unit rents we're talking about now, have increased by over 30% over the past year, Michael, which is quite extraordinary. Now, we know, and we need to point out that this is coming from a very low base, that Sydney and Melbourne had higher vacancy rates and lower rents through the COVID period in their unit markets, and this particularly reflected the CBD market in Melbourne and Sydney's inner suburban markets. Now, they were driven by closed borders, no more students, a lot more Airbnb stock through COVID coming into the permanent market. Now, that's obviously adjusted quite sharply as all those factors have reversed, and of course we know we have a surge again in migration with borders opening, and the prospect, of course, of international students re-engaging with the unit markets in the suburban Melbourne and Sydney. Again, just no relief at all for tenants over February. We expect this. This is really the beginning of the tenancy year, February. It's just another indication of that surge towards unit living, more affordable, locational advantages, but also preferences for lifestyle. But of course, those unit markets are gathered around those university sectors and higher learning sectors. And once we have that surge in international students coming back in, that'll put even higher prices on rents and upward pressure on rents, and that meaning higher rents. There's just no relief in sight at all in the unit market, Michael, and we will continue to see higher rents, and the height of the rents will only be restricted by the level of incomes growth. But certainly, I think tenants will be paying a higher proportion of their income to secure rental properties, and just no sign of any relief in the future.
No, because there's very little new accommodation being built. If we look at some of the economic indicators that came out over the week, Andrew, the monthly CPI figure came out. Now, we know this is a new figure. We know it only covers about 62% of the basket of goods that the Reserve Bank takes into account when it looks at the quarterly figures. So it's got a limited coverage. That figure came out at 7.4%. It eased a bit from the monthly figure of 8.4 annual rate in January.
Yes, Michael, I'm not sure the Reserve Bank takes a lot of attention on those numbers because, as you said, they have limited spread, depth and breadth, and I guess they're interesting at some level, and there needs to be a much stronger measuring process for that monthly result to reflect the quarterly results, but I suppose it's a start in the right direction. But the big picture is we're not seeing inflation reduce at the level we should have seen it reduce, perhaps theoretically at least, given we've had interest rate increases every month since May last year, Michael. And we're not alone here. The rest of the world is seeing some improvement in inflation, but certainly nowhere near their target ranges, which remain around about 2 to 3%. And a lot of that improvement's coming from a much lower oil price, Michael. But the big problem is that higher prices are moving into the services sector now, where we have signs of that. Certainly more than signs, that is occurring. Not at the same level as in the UK and the US, where wages growth is double what we have here, and that's certainly fueling inflation through higher services costs. But I think the big picture is higher interest rates haven't worked so far.
Well, they don't affect a large portion of the population. They don't affect tenants directly, half of homeowners who don't have a mortgage. So it does affect homeowners who do have a mortgage. But as you say, it doesn't seem to be working. It has done, though, I guess, the higher interest rates is reduced the home loan commitments. Those numbers fell over the week now to below pre-pandemic levels. But one also has to have a look how rising values distort how one interprets these, Andrew.
Yeah, absolutely, Michael. And of course, it is about the fact that values are high. But we know that loan numbers are falling and loan values are falling. And that's not a surprise, given that we have the price effect, which is lower prices, means the value of loans that are being taken out are less in value terms than they were a year ago, when prices were certainly higher in most of the capitals, but particularly the big capitals, Melbourne and Sydney, where the biggest volume of home lending comes from. And of course, the other factor is that given times of uncertainty and higher perceived risk in housing markets, the banks aren't as forthcoming in with their lending when prices are clearly rising. So I think there's also a little bit of constrained lending coming from banks, and aren't, optimistic in terms of the outlook for mortgagees coming into the market, or new mortgagees. So a little bit of risk management. But as you said, there's the value issue, and these are always lagging indicators. But there's no doubt that other indicators are positive. And I would expect to see, if markets continue to improve, that we will see a turnaround in loan values as well.
Now, one of the other things we look at is the housing approvals. It gives us an indication of what's ahead. Not surprisingly, detached house approvals have been declining month after month, but I think a lot of that was brought forward with the home builder grants a while ago. And then when you look at the monthly apartment approvals, we always say they're very volatile, because you don't come up with a big apartment tower every month, do you?
No, Michael, but the latest figures are certainly sobering. There was another sharp fall in the number of dwellings approved for building over January, which is the first data for the year. We had a big finish to the year with units last year, but as you said, they tend to be lumpy, those unit approvals. You can get a big development and then nothing the next month. But certainly the downward spiral, we could call it, in house approvals continues post the home builder surge of early 21. But that's now well behind us. And this is just, again, looking at that systemic issue of underbuilding in Australia. It is continuing. And of course, we've got to understand that it's being exacerbated. An already poor environment for new building is being exacerbated by still skyrocketing building costs. Our latest new house building cost index shows that there's really been no significant improvement over recent months in the cost to build a new house. It's still well above where it was a year ago. So what it means is a lot of these approvals, Michael, that are coming through now are less likely to become commencements, because builders, particularly apartment builders, and I've had these conversations with developers, they are finding it difficult to get a profit outcome because of high building costs, and that they may have to either postpone or cancel these projects that have been approved. And of course, there's all the issue about getting finance as well, if it's not looking to be profitable because of higher building costs. I think the proportion of commencements to approvals will start to fall. It's been reasonably close, above 90%. I think we'll start to see that falling away because of these high building costs, Michael. And of course, this just adds more petrol to the bonfire of an undersupplied housing market with higher rents and higher prices.
And despite the government talking about building more affordable accommodation, can't see how that's going to happen, Andrew. Another result that came out over the week, Andrew, was the GDP figures. Now, that's showing how our economy is going. And it's a backward-looking indicator, because it really tells us what happened at the end of last year. But what did the figures show?
Well, interesting, Michael. Of course, we did have the GDP numbers out for December. They were a little lower in terms of the annual growth rate of 0.5% compared to September 0.7%. Of course, this starts the chatter going amongst the doomsayers, and it gets very tiresome, the level of negativity in our media with any new data, always having a negative connotation. And of course, the sense is, will we see a recession this year? Well, I think clearly the answer to that is no, unless something significant from left field comes along that we can't see. So up by 0.5% over the year, the GDP in Australia, Michael. And really, when we look back to the prior to COVID, this is around about the levels we were recording prior to COVID. So there's nothing terribly extraordinary. It's certainly on the low side in terms of growth, but given how strong our economy is, reflecting the employment data and retail sales, and our housing market's improving, this data has other factors that generate the number, particularly issues such as our export performance. So, 0.5%, a little lower than September, but around about where we were pre-COVID. So still in positive territory. And I think predictions of a recession are, again, just hysterical at this stage. But if we look a bit closer at the data, again, it's household spending that fueled growth. That's been a very strong contributor to GDP. We know that has continued this year with those January numbers a little weaker, but certainly still strong for retail spending. No surprise that the savings ratio is falling or continues to fall from record levels, Michael, that were generated through COVID. And that's because I think households are digging into their savings to pay for what are higher prices. And of course, the outlook is that we'll likely see, and that's what the Reserve Bank hopes, that household spending will fall from higher rates and lower savings. And the question mark is whether GDP will weaken as the global economy weakens, and there are other predictions, but those predictions of a recession in the big advanced economies are starting to fade into the background to some degree. But if we pull down by what happens internationally, it'll be a result of our export performance. But of course, as we know, China is gearing up again. Predictions from China of 7% growth this year. That's where they're heading for. And that's good news for Australia's export performance, which includes not just iron ore and coal, but also students. So we can be happy that China's back in town to some degree, because that will only add to our GDP performance.
Well, as we said at the beginning, there are multiple messages, some positive, some negative, but that's what happens at this phase of the property cycle. I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice, because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance, and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect, and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations, and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Now, every weekend we look at the auction clearance results. You report them very early in the piece. Every week on LinkedIn, you report those, and you break them down by state and by houses and units, and even by regions in the big capital cities. We report them on Property Update as well. So people who are wanting to keep up to date with what's happening should go to those sources. And we're now into March, a couple of weeks of good levels of auctions, and the results still remain positive despite a spectre of more interest rate rises.
Yes, Michael, these are the first results at the weekend for the autumn selling season, which officially started on Saturday, now being into March. And we saw a slight easing in activity generally, but really nothing to suggest that the market had peaked. Clearance rates in Melbourne, Sydney and Brisbane all around 70%. Auction numbers were similar in Sydney, but still reasonable, 674 auctions. Melbourne auction numbers typically fall away in that weekend before the long weekend. They'll certainly have over the last few years, but auction numbers in Melbourne were down by around about 200. But the clearance rate held reasonably well at just over 70%. Auction numbers in Brisbane were down again also, with fewer auction numbers, but the clearance rate was again similar to the weekend before at just 70%. Adelaide fell down with the same auction numbers. An unusually low result for Adelaide, but nonetheless a reasonable result there for sellers. And Canberra maintaining, despite a big fall in auction numbers, its clearance rate just under 60%. I think that auction clearance rates, as you mentioned, Michael, have proven to be a very reliable forward indicator of what's happened in our housing markets. Sydney clearance rates have really tracked above 70% for this year so far. And we're surprised that we're seeing prices rising. When we look at the long-term trends, we know that once we get clearance rates above 70% consistently, we start to see upward pressure on prices. And we see the same results in Adelaide as an example of that relationship. But certainly it holds true for the big markets of Sydney and Melbourne. And I think that if Melbourne, which has had a very good last couple of weeks, Michael, holding above 70%, and Melbourne's clearance rates are the highest for nearly a year, I think if that continues, we'll also see Melbourne home prices starting to rise as well.
Well, that's going to be tested with Super Saturday coming up. There's a public holiday, so the week beforehand there's always bigger auction numbers. But there seems to be the depth there because buyers are back in the market. They just seem to be taking these interest rate rises in their stride, Andrew.
Well, that's right. And this is the problem, as we mentioned at the beginning, Michael, it just hasn't worked, has it? Higher rates haven't done anything, haven't really. A few maybe minor signs in the labour market, maybe retail sales are slightly lower, but retail sales are still booming, and the unemployment rate is still the lowest we've seen basically since the early 1970s. We have a booming economy. People feel pretty good, and regardless of what those sentiment surveys say, and I'm always scratching my head about the sentiment surveys, I think people say what they think they're supposed to say, and then they go out and buy a house or a new fridge or a new TV because it just doesn't reflect in the real economic data, does it, Michael?
Well, as I said at the beginning, there's good news and bad news in the media. There's mixed messages about our property markets, and each week we're going to be back giving you our views on what's happening in the property markets. Thanks, Andrew.
Well, thanks very much, Michael, and another interesting weekend in property and economics, and I'm sure we'll have much to talk about next week as well.